Good morning. My name's Rod Hurd. I'm co-founder and CEO of SmartBe Wealth Inc. And we're here today with my co-founder, Art Johnson, and our special guest, Dr. Wesley Gray from Alpha Architect. Alpha Architect is our business partner and runs the index for the fund that we host on the NEO exchange called SBEA. And today we're hosting our first of a podcast series called Modern Investment Journeys. We're going to try and stay on the non-technical side and on the human side of investing, have a great conversation about what prompted many of us to move to the dark side and follow a quantitative investing strategy. Art, you want to introduce yourself?
Hi, I'm Art Johnson. I'm the co-founder with Rod and portfolio manager at SmartBe Wealth in Calgary, Alberta, Canada. I think what Rod's talking about is really important. We wanted to call our podcast a journey, and we believe that a lot of the financial advice is more on the technical or insight level, and not a lot of it tells people actually how you actually practice these things. How do you keep strategies? How do you build philosophies? And how do you actually make something work with you? And I started as a quant portfolio manager in kind of 2000, and I was really fascinated more and curious about not so much how interesting these strategies were to me, but actually how they actually could change people's lives. But more importantly, how we could actually make people stick to some of this stuff, which is a little bit different. Like Rod, like Wes, like a lot of the people in our community, I don't know if we're all failed teachers or could have been teachers in our lives, but definitely that concept of being a teacher and a helper and a mentor hopefully plays out in this podcast. And I think those are the things that we're trying to do rather than just be technical experts.
Thanks, Art. For those of you that don't know Wes did his PhD at the University of Chicago, which is renowned as the world's leading institution for quantitative finance. And he did his dissertation under Dr. Eugene Fama, who won a Nobel Prize in 2013 for his work on the efficient market hypothesis. Wes tells a great story about one of the other profs at University of Chicago that was more on the behavioral finance side of things, identifying that in market data, you can take advantage systematically of human behavior. And so, Wes, through his journey, has become one of the leading worldwide experts in quantitative finance. We're really privileged to have him as a partner. Don't be fooled by his casual style or his sense of humor. Wes is definitely considered among his peers as one of the leading financial investment managers in North America. Wes's approach has been a little bit different than many. It seems like in the world of quantitative finance, there's two sort of camps. One in the Fama French camp of efficient markets and one in the behavioral finance camp of Schiller. And what Wes has done is sort of bridge these two gaps in recognizing that, humans are crazy. We make decisions with our emotions more than our logical brains in times of fear and times of stress. And when we're dealing with our money, that often comes to the forefront. And so without further ado, I'd just like to introduce Wes Gray and welcome Wes.
Hey, gents. Thanks for having me on here, and look forward to the conversation.
One of the things Rod was mentioning is that, and a lot of people still don't know this, is that there has been a tremendous amount of academic research and science and insight into investing. And that's probably not common knowledge still with the average person that's out there. So these are tough words like efficient market and Eugene Fama and all these people that are just common to us. And maybe dive into a little bit on that and what the science is all about.
Yeah, so a lot of people, to include myself back in the day, are just unfamiliar with just how much research is conducted in academic ivory tower institutions. Probably ever since I'd say, 1960s, right around Eugene Fama was there at the University of Chicago, and they started getting access to a lot more data. Ever since then, which is almost 80 years now, you have had armies of really high IQ PhD students, around the globe, looking at the data, trying to understand how and why financial markets work.
I have to interject there. I was born in the mid 60s and there's no way I'm 80 right now. I'm only 50.
Oh, yes. Well, 2000 minus 60, that's 4. Yeah, so 60. Sorry, I can't do math, even though I'm a quant.
That's pretty typical.
Last 60 years.
I wasn't even going to question that. Rod's the engineer in the room. He's the only guy that questions that.
Yeah, no, exactly. 60 years plus. But and even before that, obviously, people have been doing research, early or forever, but like even in early 1900s, there's academics talking about, different investment strategies and systematically studying them. And so what's great about that is academics and professors, really your only goal in life is to prove to your friends in the business of academia that you're smarter than they are. And the incentives are to always tell each other that you're wrong, right? So peer review systems, the whole academic edifice, it's not really about trying to make money or build trading strategies that, do this or that. It's really about just exploring ideas in such a deep way. And the currency of that business is really just coming up with really cool stuff that your peers in your profession think is also really cool. But at the same time, they don't want to tell you that. It's always about, no, your ideas are dumb. But through that whole process, a lot of ideas that come out, which are freely available in all the public journals that are out there, it's obviously got some bias because all research has bias. But relative to like a research report from an asset manager, like a big bank, where clearly there's an axe to grind because they want to sell you something, academics really genuinely just want to sell you an idea. And so when ideas move through that complex there, because that's their only real incentive, but they have been heavily vetted by so many people that want to tell people that this idea is bad, that in the end, it's just this amazing resource of knowledge that we can lean on for free.
Yeah, I've always found it a real weird paradox that probably the best insights in the world are on this website called SSRN that you can go on and load down academic papers that, the amount of time, research, and energy. And also, you mentioned two things I think that are really super important if anyone's thinking about investing or interested in the world of finance, that bias and incentives play a huge role in the financial service industry, as they do in any other industry. But they really motivate people in this industry because the incentives around bias are actually make people a ton of money in this business. And what is kind of always been fascinating to me, and what's fascinating to talk to you today, and it's a free world in a sense. It's really the battles on these ideas and not being folklore or bias or that. And what insights did you gain from that? Because you were an investor previously. You were like all of us. I think prior to my exposure to the academic thinking around how to invest, I was pretty much someone who I would say lived with investment folklore. It was my own insights into things, my own observations, what the weird dude in the corner who believed in gold talked about at the brokerage firm that I worked at. And it wasn't really kind of till I came into, leaving the folklore and giving academia that I changed my thinking. So how did that shape you? And I guess, why is that important for people? Like, why the hell? We're going to take one thing away about the academic thing. What's the big deal there?
Yeah, I'm with you. I'll tell you my story because it's like the biggest like love-hate relationship ever with, systematic, evidence-based kind of academic research strategy. So I originally started with no knowledge of that. I've always been like, hardcore value investor, like grew up on Warren Buffett and Ben Graham, who they're old school types that just say, hey, it's all about fundamentals. Do the deep dive research on individual companies, try to get the best assessment, inside scoop, and buy things that seem cheap relative to what you think they're valued at. Old school investing. And I obviously thought I was going to be Warren Buffett, put my hand in that. And actually, I did pretty well because I got dumb luck to start being a value investor in basically the early 2000s, right after the tech bubble. And value went on this epic run. And a lot of times when you get caught in a good trend, you sometimes attribute, your success to how smart you are and not the fact that you just got good luck because you happen to be in the trend. But then what happened is I entered the PhD program there, and I started learning about like these quantitative tools, this whole wealth of incredible knowledge in academic research on financial markets. This guy, Nick Barbaras, who's now a very famous behavioral economist. He was at Chicago at the time. He's now at Yale. He's good buds with Dick Thaler. He taught the behavioral finance course there. And like everything he was talking about, I was like, oh my God, like, this is
me.
Like he's doing a course on me, the idiot stock picker.
It is humbling though. Like when I started that transition too, it is just, I don't know if you happenstance into being an advisor in the investment game, you know, you've got to put certain bits of armor on that define you and various things. And then you walk into the science world and it's just basically, you're like, I'm like a bad shaman, you know, and all this stuff gets kicked out of you.
They make you feel bad for being a human.
I'm a witch doctor.
So I got kind of inoculated there. I was like, wow, this is maybe a better idea than doing this old stock picking stuff. Even though I've been doing pretty well at it, I'm going to do that. Right. So long story short, I ended up starting a hedge fund in 2008 and I launched it in September 2008, which, as you guys know,
Great
was
timing.
Like damn near the worst time you could launch an investment product.
Oh God.
Like just, you can't even time it worse than that. And the system was a systematic value system, purely automated. And I was like, this is awesome. Like did all the research. Like I don't have my behavioral baggage that Barberis and Thaler tell me about all the time, blah, blah, blah. Launched that thing all in on quant now. And then literally 3 months later, as you know, the market basically fell out. And all of a sudden, I'm like, wow, this reminds me of 2000. There's all these really cheap stocks selling for less than net working capital. This quant stuff, like it just doesn't realize what I know because I did this for 10 years prior almost. Like I need to go back to stock picking. Yeah, and I literally did that.
Full
so
Ben Graham mode then, right? Like the cigarette butts are on the ground.
I went back and I talked to the clients. Like we had one big client who's most of the capital was like 3 or 4 mil just getting started there. And I was like, dude, I know this quant stuff is great, but this is a once in a lifetime opportunity. I've been here. We've got to just do deep value stock picking again. And he's like, Roger that. Like, let's do that. Been ahead 2 years. Through like tons of stress, tons of drama. Like we do well initially, then we get destroyed. In the end, the performance on that thing is like Russell 2000, but with like 5 times the volatility. And of course, you know, I back test like, well, what if I just stuck with the damn quant model? And obviously it outperformed the Russell and, you know, me, the stock picker reformed. And so after that experience, I was just like, all right, like I need to just lock this thing down where I just cannot do discretion because it's just too seductive. And ever since then, I do not do any discretionary stuff whatsoever, even though I find a lot more enjoyable, obviously, than quant. You kind of in the weeds having fun.
More like a hobby than an investment strategy.
Was that the message from Barberis? You've got to take the insights, and this is something we're going to try to articulate on this podcast, that there are all these insights, but these insights, you know, they can be either really valuable, but they're also really cheap. And what I mean by that is that if I don't know the fact to lose weight, I've got to eat less and exercise. Well, that's a really valuable and expensive insight. But everybody knows that insight right now, so it's kind of very cheap as well. And some of the stuff in behavioral finance is like that. You know, you get all these insights that I'm a witch doctor, but you know, what you did was actually turn these things into principles that people live by. And I think that's really kind of something that we want to kind of emphasize in this podcast on that. How have different investors taken not just insights alone, but actually turn those into principles that they could own and live with. And it's kind of fascinating to hear that story because that sounds exactly what you did.
Was there a specific moment, Wes? When did it come out that you wanted to compare your stock picking performance to Russell, and then you did the back test on your old models? Was it like a specific event that changed your mind, or was it a bit of a gradual?
No, I just was trying to be disciplined and be honest with myself. Like I basically ate like a ton of humble pie, and a lot of times when you're in a position of like getting destroyed, you get a lot more introspective and thinking like, okay, obviously something happened here, and I got to just be honest, it wasn't bad luck, it's probably me. And so that made me go back and reassess like, hey, what if I had just done basically what I had learned you were supposed to do and what all the research suggests you do and what all the behavioral stuff suggests you do. And that was just like the stake in the heart. I got to stop being overconfident and stop believing my own BS and just focus on and leaning on like all this huge knowledge base that people their whole lives, all they do is try to study decision making and how to, follow processes in particular in the investment space that can at least get you in the right direction. But at least it's accessible and understandable. Whereas like, how I feel tomorrow when I'm picking stocks, like, I might pick Tesla if I drink a lot of coffee, but I may pick like, some firm in the Calgary oil patch.
Yeah.
I didn't have coffee. I don't know.
Yeah.
Like, but that shouldn't, the fact that I had coffee and my, monkey brain can be changed and manipulated just by caffeine. And the fact that that can actually affect my decision making, even though I may not know this, is just kind of a scary thing. Where like rules, they're codifiable, they're testable, they're ex ante understandable, and then ex post we can review them. It just seems like a much better way of approaching a problem than kind of ad hoc winging it.
During that time of the humility and the formulation of a disciplined belief set, were you in it alone, or was Jack there with you? Did you have a partner? Did you have mentors? What were you going through emotionally in the time?
This was prior to that. For Alpha Architect, I had, 3 ventures, but really 2 big ones where it was just me alone and afraid, and had different business partners and just screwed them up. So this is kind of my 3rd rodeo. And this one obviously has been around for 10 years. So this one worked. Prior to that, I had a couple that didn't work. And then this one, of course, because it's systematic, rules-based, transparent, much more focused on, not screwing things up. This one worked. Jack and the whole concept of Alpha Architect, that really didn't come online until 2010. And so that was when I had personally, kind of had this revelation and restudied all this stuff again to convince myself that this is not the future. Hedge funds, stock picking, gunslinging, relying on your gut and your experience and how awesome you are. It's just, that ain't going to cut it.
You raise an interesting point, Wes, though, and it's one that we always struggle with too, is that these teachable moments come from, unfortunately, us being put into humbling moments. And, and the humility is not humiliation. I think it's a different beast altogether. But maybe they don't have to put their hand on the stove 5 times. I know I'm pretty persistent too. And, I have to put my hand on the stove like 3 times before I kind of get things. I think the science of an academic research actually kind of guides you to a format and the principles that hopefully you don't have to do that, right? Because, but on the other hand, the paradox is until people kind of get beat up a little bit, maybe, we always struggle with that. Do we have to get people who are beat up, or can we actually guide them without getting their hand burned?
What helped me is I end up running into this huge psychology literature that's probably called like the model versus expert literature. Mm-hmm. And what's amazing on that, again, it's kind of like in finance where you're like, oh, wow, people have been doing quant for, not 80 years, but 60 years, because I can do math thanks to Rod now. But the same thing, like psychologists it turns out, they have been studying how humans do with judgment and like all their qualitative skills internally versus models since like the 50s. And there's this insane amount of literature out there where they basically prove and show via evidence over and over again, this is not something unique to finance. This is the human condition. Yeah. And so there's a great meta-analysis study out of like 150 studies on every prediction thing you could think of, like predicting, college academic performance, advertising sales, like success in the military, how likely you are to do suicide, whatever, like all these areas where you require experts to try to predict and forecast some outcome, none of which have anything to do with finance or investing, but it's the same kind of function. Out of all those studies, like 5% of them, they can actually identify where expert judgment can beat some brain dead model, right? The other 95%, the model either equals the expert or beats the expert. It's very rare, actually, that you can find systematic evidence that an expert's intuition and knowledge and expertise is actually preferable to literally some simple evidence-based model that we can study and test and research. And
thank God I'm not expert in anything.
This is just a human problem. It's not just investing, it's in every single thing that involves forecasting. We're just not that good at it. And after reading that paper, which is like basically a meta-analysis, and learning about this huge wealth of knowledge that the psychologists have been figuring out forever, that was what helped me.
You said, I think, just the key thing, you said it twice, forecasting, but it's really about, we can't do a good job of predicting the future. So let's let science and the past inform the decisions we're going to make today.
The question I mentioned earlier, humility and humiliation. Ceding expertise to a model almost seems like humiliation. And, it goes against the kind of core Canadian or American ethos that if you work hard, you win, and various things like that.
We're the masters of our own destiny.
Yeah, and yet the evidence is absolutely against that in chaotic systems like finance or chaotic systems that you can't predict. And
is it chaotic systems, or is it systems that rely on probabilistic outcomes?
I think, you're absolutely right. But probabilistic outcomes are things that, get defined by certain things like COVID and all these things that hit us, right? Like our innate desire as a human being, for safety and various things like that, want us to find some type of meaning in these things. And the reality is we can't control that stuff. And the certain amount of humbleness that you need to seed yourself is a real barrier to people using these things as well.
And one of the things I did is, because I was really trying to understand, like, okay, why is it that experts, who know all this stuff, they spend their whole lives thinking about this, they got all this great experience, why are they not beating these stupid models? Like, it doesn't make any sense. And so what it is, I try to break it down into basically like this 3 core assumptions of that hypothesis that experts should beat the models. And the first one is that, obviously experts have access to qualitative information, soft information. That's one hypothesis. They also maybe have more data, right? Like, so the model can only feed in like whatever you feed it, but an expert can be like, well, I got this research report from RBC, I'm going to use that too. So it's actually quantitative data, but they may have access to more. And then the other one is that experts have the intuition and experience, and maybe that has some benefit. But really the empirical question is, okay, so you have access to more soft information. You maybe have more access to more quantitative information, and you have experience. Here's the real question though. Is there any systematic evidence that soft information increases forecast accuracy? What does the data say? No. So when humans assume that their soft skills and that soft information set they get on average is helping them actually improve their forecast, empirically, it's just not true. The other one is, okay, more information. So if I have 5 data points, because that's what the computer uses, but I'm going to go out and find 10,000 data points, does that increase my forecast accuracy? And there's all these great studies about humans and how they perceive additional data as being valuable. Well, turns out that more information also doesn't increase forecast accuracy. What it does is it increases confidence.
Yeah.
I.e., you think your forecast is better, but it actually hasn't improved. And then the final element of the hypothesis that, well, okay, fine, soft information doesn't work, more information doesn't really work, but I have my experience and intuition. Well, when they go out and study, well, does that actually increase forecast accuracy? Unfortunately, on average and in general, the answer is no. So all of the 3 core elements of the hypothesis of why an expert should beat a model, empirically, they're not true, because none of those components actually enhance forecast accuracy empirically. It's just people think they do, but that's because they haven't systematically studied all their decisions that they've made. They only focus on the one that worked and be like, well, voila. I used to be like that too. Like I said, I started being a value investor in 2000, right after the tech bubble blew up, and any idiot who threw a dart at a cheap stock made 30% a year for 6-7 years. Like I didn't codify it like that at the time. I just said, oh, I'm a genius, which made me think that my, all these qualitative skills and expertise or whatever were adding value. But the reality is, now that I've had time to kind of, study and understand a little bit more about how I'm an idiot, I came to this conclusion like, wow, it's just not the case.
So with so much of this information in the public domain, it's clear that everybody should have access to it. It's very logical. My background in engineering and big data, this is why I'm attracted to quantitative finance. Why have so few retail investors adopted these strategies? What is the barrier to giving it up to models, for lack of a better word?
So the key barrier, and it's not just retail, it's like me, I dealt with this, like everyone, the key issue is ego. Every human being wants to feel valuable. You want to feel and think that if you work really hard at something, you're actually adding value. It's not going to help your ego or your confidence if someone tells you, actually, all that stuff you're doing, it's kind of a waste of time. And so that's the problem. And so really what we talked about kind of earlier is the challenge is not understanding the open secrets about how the human mind is so screwed up and why following systematic processes that are data-driven is a better solution. The problem is, to your point, how the heck do we get people to acknowledge, which a lot of people are willing to acknowledge the evidence in the data, how do we get them to actually implement these things?
Yeah.
And that goes to like, well, how do we get people's ego out of the way?
Well, I was loving our conversation the other day when you were talking about what is starting to unfold at Alpha Architect and vicariously then through SmartBe as we're out in the market trying to grow our businesses, is the psychological endowment effects and other effects to help people own these strategies for themselves seem to be the easiest path to help, change that behavioral shift or change that belief system shift.
Yeah. So actually before this, I was actually curious, the endowment effect, like who actually invented that?
Yeah.
And just so your listeners know, the basic idea is an endowment effect means that you value things that you own more than their market price is basically the bottom line. Like if you own it and you kind of have endowment on it, you perceive it as being more valuable, even though the marketplace may tell you differently. Or if you didn't own it, you would think it would be worth less. It's this weird thing. It turns
just
out
so people understand how powerful this is that are listening in, they've done experiments where they've taken the coffee cups from the university and literally sold it to the kid for $1, and they won't buy it back from him for $1. He gave him a free cup, and he'll want $2 because he now owns it to sell it back to you, even though he was going to get a free $1 out of the exchange. It's just so crazily hardwired in us as people.
Sorry, just one point of clarification before you go on. Is it the same with knowledge though, Wes?
Yes, I think. Yeah. So the issue with a lot of this stuff that we're talking about is people don't own or feel like this knowledge or this data is their own. So it's some other person's data. So therefore, we can't leverage ego and endowment effects in a positive way because people have ego related to their own skills and insights that have to do with their gut instinct.
Yeah.
So
folklore.
The trick is, how do we get human behavioral problems, specifically like in this endowment effect, and specifically, how do we get people's ego to actually work in our favor? So our solution is to make people understand and invest a lot of time in actually understanding this knowledge. So now they have an endowment effect related to the ownership of all this academic research and all this data. And now their ego says, oh, because I own this knowledge, it's now mine. It represents what I'm all about. And so now I'm going to stick with this because my ego thinks it's a good idea.
Yeah, I think it's a fascinating thing, Wes. I think we're into phase 2 of this whole, in the investment business, there's been kind of this whole explosion of academic research, which gave everyone tremendous insights. And what I love about what you guys are doing and what we're trying to do is it's this, okay, if you look at successful systems, whether it's Weight Watchers or things, what they've done is they've taken these insights and back to this concept, they've turned them into principles or, and that has allowed the people to actually build their own ownership, like, 'cause, it was funny. I was talking to Patty, who works with us, and I was putting this idea around, and I said, and she works out all the time. And I said, okay, so, exercise, lose weight, don't eat as much. And I said, can you do us a favor? And we were doing an exercise. Can you turn not eating much into a principle? And she's like, okay, well, it'd be like 80% I would eat good and da-da-da-da-da. And once she did that, man, she was absolutely tied to it. It was just fascinating. So it's, can you talk more about how you guys are taking these ideas and making the rubber meet the road?
Yeah, our mission is to give people endowment on this knowledge.
Yeah.
Not because we're trying to be nice guys, but because we want them to be better at investing and be able to be successful there, because if they're successful, we're successful. And so we do whatever we can to allow people to actually access all this knowledge. Because right now, as you guys know, it's buried in primary source journals and it's written for other academics and it's full of jargon and it's like just very difficult to understand. And so the idea, and that's what makes people never want to have endowment or ownership on it, because they can't access it. It's like, oh, a bunch of ivory tower geeks think they're better than me. And there may be an element of that, but what we want to do is say, no, this is totally relevant to you. We're going to make it accessible to you. And then we don't really care how you interpret it. And we actually encourage, advisors and people we work with, like, hey, this is how we understand it. This is how we frame it. This is how we think about it. But I encourage you to actually build your own way of how you want to communicate this knowledge and insights to your customers or your clients, because then they get an endowment where they take ownership of that education process. The whole point is, how do we get people more disciplined and more able to stick to the models, as opposed to like reverting back to like what I used to do. Oh my God, this is a great opportunity and I'm really smart. I'm going to go back to stock picking again.
In Canada, we think that you guys in the States are 5-8 years ahead of us. The universe of advisors that you're dealing with that have quantitative skill sets and knowledge in this area is fairly large. Can you help us understand the journey that an advisor goes through from a completely uninitiated stock picking world through to, I've got a belief system in quant, I'm going to stick to the rules, I'm going to be disciplined, and I'm actually taking discretion out of my life?
So the problem is investment education is fraught with tons of noise due to the conflict of interest problem, right? So
can you just can you explain to us what your concept of noise is? I mean, that's used in academic literature a lot. What is that term?
So like us as an asset manager, we have a clear conflict of interest. Like our willingness to educate the consumer is always going to be shaped in some sense because we have an incentive to sell them something, right?
Yeah.
And for most asset managers, that is obviously like a monster conflict of interest. For us, that is also a massive conflict of interest. We've tried to negate that through like having a core mission in education and a core belief of transparency. So at least you can fact check us very easily if you think we're being too biased, but we're obviously still got this conflict. So the issue is if let's say I'm a consumer and I'm like, man, I really actually want to learn what the hell is going on. But when you go to the marketplace, you're going to hear a million things about a million different ideas, and the incentives of salespeople and experts is they don't want to educate you. They want to charge you a lot of money for their expertise. So their incentive is to actually overcomplicate, add way too many bells and whistles, and lean on what they know about human psychology. Like, oh, this looks really hard and complicated. Like, and look at all these PhDs that figured this out. Like, God, I just need to hire this person. i.e., they never get endowment effect or ownership of the core idea. They got sold. So the issue is, how do we get advisors and consumers to understand that there's just some core principles and simple model ideas they're very robust. Like on average, most of the research tends to agree in these directions. Let's get people started there and then build up their knowledge of just the baseline fundamental building blocks, and then also build up their defenses against salespeople who always want to make things more complicated than they need be, because that's their incentive, is to make sure you don't think you can do it yourself.
Yeah, we have a fascinating industry, Rod. Like we turn kind of very simple ideas into very complex ideas, like a disciplined investment process. That's like kind of saying that Ford saying that your new sedan has 4 wheels. Like it's a very basic concept, but like our whole industry creates a lot of noise around these ideas.
Well, and think about why now. Now that we've learned about like what we're trying to do, well, I want people to get endowment effect on the knowledge. I want them to know that, yes, they could DIY this.
Yeah.
Why is, to me, that a psychology trigger that's good? Because I now know they have ownership of this idea and confidence in what the hell's going on, which means that in the end, are they really going to DIY? No, they got other better things to do. But now they have endowment effect on an idea and they're going to be disciplined and able to stick with it. Whereas most asset manager and financial service firms, they don't want the consumer to have endowment on anything. They want to have endowment on the idea because they want to just sell them the next greatest whiz-bang mousetrap thing. And then just, if that doesn't work, fine, we'll come up with a new one, sell them that. They have no interest in giving the consumer endowment effects because they're worried that if they had endowment effect, they'd be like, well, why do I need to hire you?
Yeah.
I'll just DIY it. Whereas we've worked through this psychology of like, no, like we want people to think and understand enough where they can DIY it. Because the reality is investing is DIYable. But then on the flip side, do you really want to like do this? There's a reason there's financial services. Because if I'm, working on an oil rig, I don't got time to like manage the portfolio and deal with it all. So I'm going to hire someone. But the key is we want that person, if we're going to do like a simple model or simple strategy or some process that's based in research, the key element is, can we get them to stick with it? Well, the key psychology thing we need is endowment and ownership of this idea. Otherwise, they won't stick with it. And so that's why, simple, straightforward, transparent education about just the facts, in our opinion, is very important.
So how is that translated in the U.S. into the advice that's down there? Because you're not alone.
Yeah. So advisors down here take ownership. They kind of say like, you know what? I know there's a better idea. I've been reading this stuff. Voila, I actually get it. You're right. Like there is all this research. Like these are open secrets. I now finally understand kind of like what is going on here and why this is a better path. And now I am going to embrace this as my investment philosophy, my investment culture, i.e. now I have endowment effects. And then their role as an intermediary, which is a highly valuable one, is to kind of convey that to their clients as well. Because in the end, what we're really trying to do is get the clients to stick with like a reasonable investment process. So even if like the advisor knows it, but he doesn't help educate his clients and build endowment there, it all falls apart. But the whole point is like we want the whole chain, the asset manager, the intermediary, and the end client to gain ownership and endowment on these ideas. So we're all in the same boat rowing and we're going to stick to the program.
There's a challenge that I see though, Wes, in that the word quantitative finance and quantitative investing, quant, means different things to other people. How do you as an asset management firm or ourselves help both the advisement community and the retail investor understand that not all quant is the same, that there actually are some people that position themselves as quantitative investors?
What I like to think about investing is first principles. So there's some investment idea or investment concept we have. One might be, the most simple one would be like value investing, right? Buying cheap stuff relative to fundamentals. Now, we could go do this with the discretionary hand. We could also just have a basic set of rules that everyone understands that captures the genesis of this first principle accurately, repeatably, and with clear transparency. That's the kind of quant that we're trying to execute on. How do we just systematize first principle, evidence-based concepts in a way that everyone kind of knows what we're going after? There's another form of quant, which is just backroom, all the PhDs, 200 IQs, doing 5,000 layers of complexity where no one really knows what's going on in the black box. The pitch is that the black box is producing like monthly returns of 1% every month with no risk. The reality, and a lot of people buy that pitch over and over again, which is why, there's quant shops that sell that, and that's totally fine. The reality is there's maybe 1 in a billion, i.e. like maybe Jim Simons or something at Rentec, that actually have done that. And so we're just trying to codify and systematize good ideas in a simple, transparent way so people can gain endowment effect and own those ideas and help their clients own those ideas. We are not trying to make people PhDs in physics, which no one will actually end up understanding and no one will get endowment effect on, which means we're back to the same problem.
One of the reasons I think we want you on and to talk about is we're in Canada. What we're seeing across the border is there's been a transformation in all of this in the whole financial community in the US. There's this transformation where advisors are moving away from, I'm the expert, you stay out of my kitchen, I'm the black box, to these new advisors that are following people like you and Vanguard and a whole bunch of other things are happening there, actually going down this transparency role. And it looks like the engagement in the States in this type of a business model is growing at an insane rate. In Canada, we do have some barriers here to that type of a business model, mainly just because, the banks are a syndicate here. But that business model will be coming to it. As someone who's maybe looking for an advisor, can you talk about what is happening in the US? Like, why are people grabbing this transparency? Why is that transforming the business in the US?
Well, I think people are down here more and more just recognizing that if you're a financial advisor and you want to maintain a business where you have a long-term sustainable relationship with your client, it's much more important that you're not the role of a salesperson that's just like, selling darts, selling ideas every day. You really want to be in the position of being like a fiduciary / educator / coach. Because if you end up kind of owning that role of basically the professor, and your clients in some sense are your students, where you're trying to help them understand and make better decisions and grow, you got a friend for life. Whereas if you're out pumping like, well, I'm the best pot stock picker out there, pot stocks may not work forever. And they're like, I'm going to go hire the next guy down the road who now is the better, electric car stock picker guy. So I think what people have realized down here is that's an unsustainable long-term business model. If I want to invest the time and effort to build my annuity business via like a fiduciary focused advisor business, I want to build and sustain long-term scalable relationship with my clients, i.e. I need to be the teacher / coach and focus on a set of core ideas where everything's the same message, the same principles, forever. And then the clients get taught on that. And then once they're in that kind of culture, I mean, they're going to be there as long as you're, doing the right thing and charging reasonable costs and adding value. They're never leaving. And so I think it's just a better business model, and people are finally seeing that. And so obviously, if there's a better business model, a lot of times it attracts people to that, that methodology. And that's why I think people are going gangbuster on this down here in the States.
This whole conversation about the endowment effect and getting advisors and people to own the knowledge themselves, you often talk about this concept of no pain, no gain, that oftentimes these quant strategies make you suffer, that you underperform for long periods of time, general market indices or whatnot. Is there any evidence or research? Because the other thing that's fascinating to me about human behavior is really this whole concept of performance chasing. Everybody's best investment is the one that's doing the best right now. And we just have that in our DNA that we want great performance because it's important to us. Money is super important to our futures, to our kids, to our legacy. Sure. Is there any evidence that the endowment effect is or can be more powerful than the other innate desire to chase performance?
Well, I mean, obviously, there's so many human nature issues that, deal with like performance chasing. And one of the things that we help educate people on when you actually start reading research and studying what works, what doesn't, is there's a ton of stuff that works. But when you actually dial it down and think, well, this thing's pretty simple. Why does this work? But then you mechanically go through, oh, this thing can drag on the S&P for years on end and you look like a total idiot. i.e. you can lose your job in the short run because so many people are focused on short-term relative performance, that's just a fact. And so one of the ways you can build, again, going back to endowment effect and building people's defenses is how do we get around the performance chasing problem? Well, the short answer is you never will get around that completely, but we're not trying to partner with every single person on the planet. In fact, we kind of rely on people being idiots in mass, and that's actually a great thing. Like, I don't want to eliminate the fact that people performance chase, because that's a lot of times what leads to these effects of like value, momentum, what have you. So what I want to do is I want to communicate to folks up front and anti-sell. This is a reality. Like, you need to own this relative risk and be almost like an innovator or a pioneer, and you have to be different to be good. And if you just tell people that and they don't own that idea, or they don't appreciate that idea, or that's not part of their pitch, i.e. they don't have an endowment effect on it, it's like, whatever. But to the extent you can say, listen, this is what works, but it's not a free lunch. You're going to have to deal with like the relative performance and all these hard conversations. But if you own that and you communicate that to your constituents that, hey, our edge is we are not like all the sheep out there that make stupid decisions and try to follow the hottest thing since, sliced bread, then it works.
So you've been not on the asset management side, but on the advisory side, running quant portfolios with the academic rigor for 15 years, give or take. What's your experience in coaching and educating your client base to understand periods of significant underperformance, and how have you manifested this endowment effect in your life?
I think in the original days, we got really jazzed that we had insights and thought they were super value, because to be honest, like when you start in the finance industry, no one actually takes you through what Wes went through at the University of Chicago, which is how do markets actually work. The original business of the brokerage business was set up almost like a utility to sell stocks. Just like an energy factory, the energy would come in and my job's to go sell the energy. I didn't really, I remember when I was a kid, one of the big stock sales was the AGT, the Alberta Government Telephone, going, public.
It's not America's Got Talent.
Yeah, exactly. And really that model still, it kind of influences things today. And this is where it's so intriguing me what's going on in the States, is that model was at my job, I was paid a commission to sell a unit of the Alberta Government Telephone to you. I did not care what that unit did or performed or anything afterwards. The whole incentive model was based on how many units of X could I sell. And what happened in 2000 in Canada is we started to introduce fee-based accounts and people started to go to this model. So, long story long, to answer your question, we're in this revolution too, where at first we got excited about the insights from academia, because quite honestly, it was a pretty frustrating job to not know how markets worked. and yet you've been tasked with running portfolios. When the job changed from I'm a stock seller to a portfolio manager, you kind of got to know how things work. And then, so academia gave me kind of the confidence and the bridge to understand, well, okay, yeah, I know how to lose weight now. And like, these are the principles. And I absolutely believe with Wes, this has to be something that you have to become a teacher almost. You have to become a friend and a guide. And where we're going, and I think the route that most will have success on this route, is to take these insights and turn them into principles, and then tell people that it's principles, not perfection. You're not going to be perfect to these things. So you are going to chase performance. Like we can't take the human out of the deal here. But what we can say is, yeah, get with an advisor, get with a coach who's, almost, kind of like a sponsor to you, who's going to, when you're up against these things, do these things. And then the other thing I've learned, we're very transparent in what we can and can't do. And that takes a lot of just nerve to do. It's really hard to be that transparent. The clients are looking to you as if you're a shaman in some ways. So, but what works is bringing it back to these endowed core principles. Do you still believe in these principles? And I remember, I originally worked with Dimensional Fund Advisors, and David Booth he would always say, do you want me to make money or do you want me to follow the index? And that's what Wes is saying. Like, eventually this stuff makes money, but I can't follow the index. And so, you got to have some principles you live with.
Well, one thing just to kind of tie up that conversation and, how other people might use these different tools to like transform their business and make it more tangible. The reality is every single advisor shop, every single intermediary will be different, right? They can use these tools, but depending on who you are and who your client base is, like maybe some advisors or some clients, they can't go all in on this, right? Or maybe it needs to be adjusted in a particular way for like the culture or psychology of their practice. So one of the things that's the role of the asset manager, like or DFA or us or SmartBe, is it's really on us. If a client, like an advisor client, comes to us and says, "Hey, I want to do this," well, the problem is it's not a one size fit all. We're going to have to sit down and be consultative, not judgmental, and help that advisor incorporate these ideas into their practice. And what I always tell people is, listen, do you believe in the following? Do you believe in education? Do you believe in transparency? Do you believe in no kidding, doing right by your clients and making this a lasting relationship? As long as you believe in those things, we should have a conversation and we can help you. That doesn't mean you're going to get the same solution that I gave to Joe Blow or Susie Q down the street. You're going to get your own flavor, but as long as you have those core beliefs of education, transparency, and doing, creating a genuine win-win with that client that you're trying to help out, this stuff I think adds value.
In addition to the philosophy, so the value system that you just described around transparency and education and win-win, the win for the advisor is being on the innovative side of things, having economies of scale with building models, having a more efficient practice, being able to rely on the evidence to, scale more. So I think the win for the advisement community also is probably a more profitable business model than the traditional one.
Well, the old model sucked, Rod. It really is hard to pick stocks and pick managers. I came from the trading floor and I became an investment advisor. And, one of my seminal experiences, kind of like Wes, I got a research report. I liked technology and I got it on a company called Corel Draw, which was a kind of Canadian tech story. Them. Our analysts has got it at $13. I'm buying it at 12, thinking I'm brilliant, and it goes straight to 8. And I'm like, this is what I do for a living? I phone up these people who I told they could trust me. And, I got to stand behind this research report. And that's when I started to say, I got to get a better system. And to your point, yeah, there are all these win-wins, but there's also this side where it just kind of destroys your soul when you give money to a money manager and he tells you you're going to beat the market, and you go talk to your clients and you hype this guy up and then he underperforms. And then you go to the next one and the next one and the next one and you just go, my God, there's a reason why a lot of people used to drink a lot in the financial service industry because, it's just soul destroying. So there's tremendous empowerment, I think, for not only the industry, but actually the clients and the customers. And, Wes is always a fan of saying win-win. And it really is. Like, this is an industry that historically it's been win-lose.
Well, that empowerment and humility feel like sort of the opposite two sides of the same coin.
And the main thing I just want to emphasize there is, because we see a lot down here, is we get folks that honestly, especially on the advisor side, like they want to do this, but they're like, oh man, this is like a wholesale redo on everything. Like, but then we have to communicate. We're like, listen, man, this is not something that you do overnight. Like we can still incorporate a lot of the benefits of this, and it's not going to require a lot of brain damage on your behalf. Like, it's not like we're going to wake up tomorrow and change colors or something. So it's just one of those things where this is not something you just like do all in. You can have it adapted and customized to your unique circumstance where you may have different constraints or limitations. And so people shouldn't be afraid of the quant stuff, the factor stuff, like the systems, because it's totally adaptable to their situation.
I think people can tell stories and good salesmen can sell anything, but what I loved about Quant is that it wasn't a castle made on sand, is that these were bedrock principles that had rigor and, as much academic truth around them. So if I was going to build a belief system in a castle, my previous castles were kind of built on folklore and because selling's tough, being an advisor's tough, dealing with, tough markets is tough. If you have these kind of bedrock things that have a lot of actually rigor and truth to them, it's a lot easier to go out and fight the fight.
And the key thing to emphasize on that is it's not like what the academic research says is like the truth of the world, because no one will ever know the truth of the world. We just always want to seek to find intellectual truth. And I just trust the process through which that research goes, just because when people in academics are arguing, they're trying to smash the other guy's face in and not let them get their new idea out. And everyone retest everyone else's ideas, and their whole role in life is to poke a hole in it. So ideas that kind of emerge out of a culture like that of no, it's not Mr. Yes, it's Mr. No. I just feel, to Art's point, like it's a foundation that is not perfect, but it's a lot more stable, arguably, than foundations based on narratives or one person's high IQ potential.
I always think of it as stacking the odds in your favor. And you're right, the battleground of academia is a tough one, and it's an uncertain outcome in the future. And anything that we can do to have a little edge of putting the odds in our favor is a good thing to do. So if I'm thinking about today's conversation, and thank you, Wes, it's been a real terrific having you on the show. And thank you, Art, for all of your insights. But it feels like both of you went through a similar sort of investment journey, that you both started out having a high belief system in your own skills and an endowment associated with being able to pick winners and losers, and different events in each of your lives brought you to this vast area of academics. And the fact that the best and brightest minds of the world are looking at markets all the time, trying to disprove each other's best thoughts. And through your journeys have sort of taken the best, not even just from the finance side of things, but also from behavioral economics and psychology and other things, and have really shaped your philosophies and investment thesis and your value systems around some core tenets that have been in the public domain, but not necessarily widely understood. And I've learned a lot today and really appreciate all of your guys' time. Wes, thanks again. Any final parting words to the SmartBe group?
Just go out there and educate and find win-wins. Can't go wrong with that.
Awesome. Okay, well, this has been a great episode of The Modern Investment Journey. My name's Rod Hurd, co-founder with my partner here, Art Johnson. And if you've liked what you've heard today, we're going to try and keep it light and on the human side. We've got a really great lineup of guests over the next couple of weeks, and we'll look forward to you tuning in again. Thanks so much.
Awesome. Thanks, guys.
The information contained in this podcast is 1, for Canadian residents only, 2, for informational purposes only, and 3, not intended to be, nor shall it be interpreted as, a recommendation or the provision of advice, including without limitation financial, investing, sales, marketing, legal, accounting, or tax advice, and shall not be relied upon by you in that regard. SmartBe Wealth Inc. cannot guarantee the accuracy of any information contained in this podcast that is derived from third-party sources, although we believe those sources to be reliable. SmartBe Wealth Inc. and its affiliates may receive compensation derived from investments in or sales of its products or both. SmartBe Wealth Inc.'s products described in this podcast may not be applicable or available with respect to all investors and may change without notice. Past performance does not guarantee future comparable results. Exchange-traded funds, ETFs, are not guaranteed. Their values change frequently and past performance may not be repeated. Investors will pay management fees and expenses, but they will not pay commissions or trailing commissions, and they may experience a gain or loss from their investment in or sale of an ETF. You may request a prospectus for an ETF from your financial advisor by visiting smartbewealth.com or by calling SmartBe Wealth Inc. at 403-930-8693. The prospectus includes investment objectives, risks, fees, expenses, and other information that you should consider carefully before investing. Please consult a lawyer or tax professional regarding your specific legal or tax situation, respectively.